There's a pattern hiding in plain sight. It's older than every market guru on TV, stronger than the latest tech buzz, and colder than a banker's signature. And it does not care what we believe. It turns, and everything turns with it. If you zoom out far enough, the story is always the same. Prosperity, complacency, leverage, denial, then the snap. The dates change, the faces change, the math does not. It flagged 1873. What if the crash you're waiting for isn't coming at all, because it already started moving beneath your feet? What if the calm headlines, the modest rallies, and the confident forecasts are just the warm air before the front hits? This isn't speculation, it's mathematics. Across centuries, economies breathe in seasons, a creative spring, a roaring summer, a deceptive autumn, and a brutal winter that clears the excess. We postponed winter in 2008. We papered it over with zero rates and oceans of credit. We didn't cure the fever. We dosed the patient and sent him back to work. Here's the part nobody wants to talk about. When you delay a reckoning, you don't erase it, you compound it. Debt did not vanish, it multiplied. Risk did not dissipate, it migrated. Bubbles didn't pop one by one, they rose together. Stocks, bonds, property, even the things we once called safe. When everything floats on the same tide, everything falls when the tide goes out. So ask yourself, why do we think we'll be the first generation to beat the cycle? Is it because we have better software? Because the government will find a way? Because the last bailout worked for a while? Look at how people behave at the edge of every peak. We stop asking, what is this worth, and start asking, how much did it go up? We anchor to last month's high, not next year's cash flow. We copy the herd because it feels safer. That comfort is expensive. I'm not here to sell panic. I'm here to sell clarity. The pattern is not mystical. It's human. We overbuild, we overborrow, we overpromise. Then we learn painfully why limits exist. The learning is called winter, and winter is not the end. It's the reset that plants the seeds of the next spring. You don't have to predict the exact day. You do have to respect the clock. The hands are almost vertical. The warnings are in front of you if you're willing to see them. And if you prepare while everyone else is laughing, you won't be laughing last. You'll still be standing. Don't look away yet. Before we talk about what to do, you need to see why 2026 sits at the crossroads of cycles that have never lied. If the past is a map, this is the red X. What worries you most right now? The numbers, or the feeling that no one's in control? To understand what's coming, you have to understand the rhythm beneath it. Because the economy doesn't move in straight lines. It moves in seasons. And these seasons don't care about presidents, parties, or promises. They follow one thing only: human behavior. A Russian economist named Nikolai Kondratiev saw it a century ago. He studied 200 years of data, prices, wages, interest rates, production, and realized that history pulsed in repeating waves lasting about 50 to 60 years. He called them long waves. Each wave passed through 4 distinct seasons: spring, summer, autumn, and winter. They weren't poetic metaphors. They were mathematical descriptions of greed and fear. Spring always comes after destruction. It's the rebuilding phase: low debt, cheap credit, new inventions rising from the ashes. Think of America after World War II: GI Bills, suburban booms, highways, and cautious optimism. That was a Kondratiev spring. Then comes summer, the age of prosperity. Jobs everywhere, wages rising, confidence soaring. The 1960s were that golden summer: the space race, manufacturing dominance, forever growth. But prosperity always plants the seeds of its own decay. Autumn follows, the deceptive calm. Inflation heats up, credit expands, speculation replaces production. Everyone believes the party can go on forever. The 1970s stagflation and the dot-com mania were different branches of the same tree. Too much heat, too little discipline. And then, inevitably, comes winter, the cleansing storm. Debt becomes unbearable. Bubbles burst, banks fail, unemployment spikes. Winter is not punishment. It's the consequence of pretending autumn could last forever. It burns the excess so that spring can start again. Here's the uncomfortable truth. We are in late autumn now, moving fast toward winter. Every indicator, debt ratios, yield curves, investor psychology, matches the pre-crisis patterns of every past collapse. The only reason it hasn't broken yet is that central banks built a dam of printed money. but the water is still rising. You can ignore the calendar, but you can't ignore the weather. Because when the season changes, it changes for everyone. Rich, poor, saver, borrower, believer, skeptic. So ask yourself, if the economy moves in seasons, which one are you living in right now? Every empire falls for the same addiction, debt. It starts as medicine, ends as poison. It's how civilizations buy more time, more comfort, more illusion, until the bill arrives. In 2025, the U.S. federal debt just crossed $37 trillion, a number so big it doesn't even make sense anymore. The interest payments alone now exceed $1.2 trillion a year, bigger than the entire defense budget. Think about that. America spends more paying for yesterday's promises than protecting its own future. And it's not just Washington. The average American household is now drowning in over $104,000 of combined debt. Mortgages, car loans, credit cards, student loans. Credit card balances hit a record high, and the average APR sits around 24%, the highest in 4 decades. Every swipe feels harmless, until you realize the interest is compounding faster than your income. This is what late autumn looks like. Prosperity on the surface, rot underneath. In the 1960s, debt fueled innovation. In the 1980s, it fueled speculation. Now it fuels survival. People borrow not to invest, but to stay afloat. Meet Janet, a retired nurse from Ohio. She worked 40 years, paid every bill on time, and believed her 401k would carry her through retirement. But inflation quietly stole 20% of her purchasing power in just 3 years. Her grocery bill doubled. Her property tax went up. She started living on her credit card, just for a few months. Now she owes $18,000 and can't pay more than the minimum. She isn't reckless, she's trapped. Multiply Janet by 50 million households and you get the real picture of America's economy. A nation surviving on tomorrow's income. Debt creates the illusion of wealth. It lets us live in houses we can afford and drive cars we don't own. But every dollar borrowed is a future dollar already spent. And when interest rates climb, that future collapses into the present. We've seen this movie before: Spain in the 1600s, Britain in the 1970s, America in 2008. The faces change, but the math doesn't. When interest consumes growth, collapse follows. So how much debt would it take before you'd finally panic? When your paycheck goes to interest, when your government borrows just to pay interest, or when the entire system pretends the math doesn't matter. Because that's where we are. And the one thing history guarantees, when debt becomes the drug, detox always hurts. After 2008, the world didn't fix the system. It inflated it. Instead of letting the weak fail, central banks hit C-Trell print. Trillions of new dollars flooded the markets. Interest rates dropped to 0. And the message was clear: don't worry, we'll save you next time, too. That promise created the most dangerous illusion in financial history: the illusion of safety. Normally, bubbles form in one corner of the economy. In 2000, it was tech stocks. In 2008, it was housing. But after the bailouts, stimulus, and years of easy money, something new happened. Everything started to inflate at once. Stocks hit record highs. Bonds, which were supposed to be boring, hit record highs. Real estate soared. Cryptocurrencies exploded. Even collectibles, sneakers, and Pokemon cards turned into speculative assets. The everything bubble was born. By 2025, the U.S. stock market is still near all-time highs. The S&P 500 trading around 20 times earnings. Housing prices remain 45% higher than before the pandemic. Crypto is back on the rise. People are celebrating wealth again. But the quiet truth is this: when everything is in a bubble, nothing is safe. Because when the tide falls, there's no lifeboat left. Everything sinks together. This isn't the first time human optimism has outsmarted reality. In the late 1920s, people said, "We've entered a new era." In 2006, they said, "Housing never goes down nationally." In 2024, they said, "The Fed can engineer a soft landing." But mathematics doesn't do soft landings, it does gravity. Meet Ryan, a 34-year-old software engineer who started investing during the pandemic. Every video he watched said, "Buy the dip." Every app notification cheered him on. He watched friends double their crypto, triple their Tesla, quadruple their confidence. He felt left behind, so he joined the crowd. Margin loans, options trading, a little FOMO in every tap. Now his portfolio is red, his debt is real, and his faith in experts is gone. He didn't gamble. He did what everyone else did. And that's exactly the problem. This is herd behavior at scale, the psychology that drives every mania and every crash. When everyone believes this time is different, history smiles and repeats itself. So let's ask the question no one on CNBC dares to say out loud. If everything is in a bubble, where do you hide when it pops? In every past crisis, the Federal Reserve had a weapon. In 2001, they cut rates. In 2008, they printed money. In 2020, they did both, on steroids. But now, the weapon chest is empty, and the monster they created has grown too big to control. Let's look at the math. U.S. federal debt sits at $37 trillion. Interest payments are already over $1.2 trillion a year, projected to hit $2 trillion by 2026. That would consume 40% of all federal revenue just to service old debt. At that point, America will be borrowing money to pay interest on borrowed money. It's like paying your credit card with another credit card and calling it growth. This is what economists politely call a debt spiral. There are only 3 exits, and none are pretty. Default, admit you can't pay, political suicide. Austerity, cut spending, voter suicide. Inflation, print and pretend, the usual choice. And inflation, though invisible at first, is a slow national bankruptcy. Every dollar saved loses value quietly, like sand slipping through your hands. But here's the catch. If the Fed keeps rates high to fight inflation, the government bleeds faster. If they cut rates to ease debt pressure, inflation reignites. It's checkmate. No more moves left. This is the psychology trap of every empire's late stage. The belief that you can manage collapse with paperwork. You can't. You can disguise it, delay it, rename it. But you can't repeal arithmetic. The Fed calls it soft landing. History calls it denial. Because when you choose to delay pain, you guarantee catastrophe later. The pattern is clear. Spain printed, Britain devalued, the Soviet Union lied. Every empire that reached this point discovered the same law of gravity. When debt outgrows productivity, collapse isn't a risk, it's the default setting. So imagine this. You're Jerome Powell sitting at that mahogany desk. Raise rates and crash the system. Cut rates and destroy the currency. Every crisis has a trigger. It's never random. It's always the weakest link snapping after years of pressure. And once it snaps, the dominoes fall faster than anyone expects. In past collapses, the trigger was obvious only after the fact. In 1929, it was margin debt. In 2008, subprime mortgages. In 2026, it will likely be commercial real estate and regional banks. The silent fault line nobody's watching. Here's the setup. Between 2024 and 2027, over $1.5 trillion in commercial real estate loans must be refinanced. Most of them were issued when interest rates were 2-3%. Now, refinancing means 7-9%. That is not a small bump. It is a death sentence for thousands of office towers, already half empty after remote work hollowed out downtowns. When those buildings can't cover their new interest payments, defaults cascade. When defaults cascade, regional banks take the hit. When banks fail, credit freezes. And when credit freezes, the real economy suffocates. The timeline fits perfectly. The yield curve inverted in July 2022, stayed inverted for more than 2 years, and finally normalized in September 2024. Historically, a recession hits 6 to 18 months after the curve uninverts. That means March 2025 to March 2026. That's the window, right where the refinancing cliff stands. Now layer on the debt service ratio. Households now spend over 15% of disposable income on debt payments. Every time that number crosses 15%, a recession follows within 18 months. We hit it in mid-2024. Add 18 months, late 2025 to early 2026. All arrows point to the same place. The first domino might not even look dramatic. It could be a small regional bank in Texas, a European bond fund, or a Chinese developer missing a payment. At first, the media will say, it's contained. They always say that. In March 2007, they said it about subprime. In 1929, they said it after the first mini-crash. Denial is part of the cycle, because the moment people admit it's systemic, panic begins. This is the contagion phase, when fear spreads faster than data. Banks stop lending. Corporations hoard cash. Investors dump assets, not because they're worthless, but because they might be. Confidence collapses. And the system built on confidence collapses with it. The government will respond exactly as it always does, with reassurance. Fundamentals are strong. Temporary turbulence. And the crowd will want to believe them because denial is comforting. But by spring or early summer 2026, reality won't ask for permission. The dominoes will already be mid-fall. So the question isn't if something breaks, it's which domino goes first, and how many follow before the system stops counting. Patterns don't lie, they repeat. And when multiple cycles overlap, history doesn't rhyme, it shouts. Let's connect the dots. The Kondratiev Wave, that long 50-60-year rhythm of economic seasons, last peaked in the late 1960s to early 1970s, right before stagflation hit. Add 60 years, and you land exactly where we stand today, 2025-2026. Then comes the debt supercycle, roughly 70-80 years long. The last time global debt saturation hit critical mass was 1930-1940 during the Great Depression. Add 80 years, and you arrive between 2010 and 2020, right when central banks doubled down with zero rates and endless printing. We didn't reset, we postponed. Now that debt wall is maturing, 2025-2026 again. Finally, the generational cycle, roughly 80-90 years, one human lifetime. Every 4 generations, societies forget the pain of the last major crisis. The people who lived through the Great Depression, who knew real scarcity, are gone. Their grandchildren grew up in abundance and debt, and every generation that forgets pain must relearn it. The last generational crisis was 1929 to 1933. Add 90 years, and where do we land? 2020-2025, 3 separate clocks, all striking midnight together. If you were watching this from space, you'd see history folding over itself, cycles reinforcing each other, like waves colliding in a single massive crest. And what's the visible proof? The yield curve that inverted longer than at any point since 1980. Record corporate bankruptcies in 2024, credit card delinquencies rising 50% year over year, U.S. savings rates collapsing to the lowest level since 2007, commercial real estate vacancies breaking records. Every indicator screams late cycle. But here's what most miss: cycles don't just end with a crash. They reset through one. The collapse isn't the anomaly, it's the renewal. History doesn't care about optimism or politics, it cares about balance. And balance always returns, through pain, through loss, through the math no one can vote away. So why 2026? Because the math lines up, the psychology lines up, and the denial phase is almost over. The next season isn't a possibility, it's a schedule. And like every winter before it, it won't last forever, but it will change everything. When winter finally hits, it won't announce itself with fireworks. It'll come quietly, through layoffs, frozen credit, shrinking portfolios, and headlines that start with unexpected. But every winter in history has one hidden truth. It's not the end. It's the reset that clears the debris so spring can grow again. If you understand that, you stop fearing the storm and start preparing for the soil that comes after it. Here's what survival looks like. First, kill the debt. Debt is quicksand in winter. When income slows, debt doesn't. Pay down credit cards, car loans, personal loans, anything with floating interest. Because when rates rise and jobs tighten, debt turns from a tool into a trap. In every collapse, those who owed nothing had options. Those who owed everything had none. Second, hold liquidity, not illusions. Cash isn't trash when everyone else is desperate for it. Build reserves slowly, not to hoard, but to buy when panic discounts everything by 80%. The greatest fortunes of the 20th century were built in the ashes of the 1930s and 2008. The ones who survived winter didn't time the bottom. They prepared before the fall. Third, own the real. When paper burns, tangible assets stay. Gold, silver, farmland, energy, skills, networks. Not the kind of wealth that lives in a trading app, the kind that feeds, heats, and protects your family when the system hiccups. Fourth, rewire your mind. This is the hardest part. When headlines scream collapse, your instinct will say, sell. But history whispers, hold, because the deepest fear of every bear market is the birth cry of the next bull run. The pain you all feel isn't it the system dying, it is the delusion dying. Remember, every Kondratiev winter ends the same way. Debt destroyed, assets cheap, innovation reborn. The Great Depression gave us modern finance and manufacturing. The stagflation of the 1970s birthed Silicon Valley. The 2008 crash fueled the digital economy. Winter always burns the old to reveal the new. So ask yourself, when the reset begins, do you want to be scared money or smart money? Because there's no neutral position in winter. You're either surviving or surrendering. This isn't prophecy, it's preparation. 2026 is not the apocalypse. It's arithmetic catching up with arrogance. And those who see it clearly, who shed debt, build cash, and hold conviction, will step into the next spring not broken, but reborn. What's your first move if the crash comes sooner than you think?